Hey everyone, welcome back to the second video on the channel. Today I'll be covering e.l.f. Beauty, a cosmetic and beauty retailer that I have no understanding of, to be honest with you. Well, it's not products that I generally use, so I wouldn't have much, of a clue about. But I thought it was interesting to dive into this industry as a whole because of the large drawdown that we've seen in it. Names like Estee Lauder, Ulta Beauty, and e.l.f. Beauty have been drawing down lately over the last few months. And I thought it was interesting to get understanding of the fundamentals of this business and then a deeper look into the valuation. So I'll be dividing the videos into two sections. And please let me know if you enjoy that format, if you prefer it to be just one video on the deep dive and then another video on the valuation side of things. And without further ado, I'll just get right into it.
All right, so the e.l.f. Beauty deep dive. So let's start off by looking at the history and founding of the business. The company was founded in 2004, and e.l.f. stands for eyes, lips, and face. And, well, of course, everyone has that, so that's not a differentiator for the business. What was differentiating them from the competition was the fact that they were vegan and cruelty-free, so they don't test their products on animals. And that allowed them to get a little bit of a foothold in the market initially, selling like $1 cosmetics. And I think they were partnering initially with Target as their largest retailer. And eventually the founders, two of them, had stepped out of the business and a new CEO was appointed in 2014. And the company has since gone public in 2016. The company actually divides the umbrella of brands they have as e.l.f. Cosmetics, e.l.f. Skin, Naturium, Well People, and Keys Soul Care. Two of those are actually acquisitions. So you have Naturium and Well People are actually two acquisitions. What Naturium was for roughly 350 million and Well People was like 27 million in cash, which is almost nothing for this business. And the good thing to see is that the majority of the revenue is actually being driven by the organic growth of the e.l.f. Cosmetics and the e.l.f. Skincare side of the company. The Keys Soul Care is Alicia Keys, I guess partnership, but they don't actually, I couldn't find information yet about that if I dig a bit deeper, but I think it's important that you get the gist that this is actually an organic business more so than an acquisitive business at this stage, but they are prepared to do some tuck-in acquisitions if needed. So let's look at the value proposition of the business a bit closer. Now, I already mentioned that this is vegan and cruelty-free, but additionally, it aims to be affordable to the masses. And as such, i.e. word of masses, it's a mass market cosmetics company, generally speaking. There are two sides to the cosmetics industry, if you weren't aware, which are mass market products and prestige products. Those are a higher end. And some people have already thrown around the terms that there's this mastige, which is like a blend between the mass market and prestige brands, which they try to walk the line of by having a higher margin product, higher pricing power, while still being generally very affordable. As you can see here, they highlight that it's $49 versus for the prestige brands versus their own versions, which are $14, $38 to $10. So you get the idea. They're generally trying to be more affordable and appeal, especially to the Gen Zs who probably don't have that much purchasing power, and millennials as well. And those are their general markets that they're operating in. The other thing I would highlight, and they don't call it such, but I think I would call it fast beauty. They are innovating a lot and producing a lot of products, maybe 70 a year. And that's something that, well, maybe because of their size, how lean they can be, they're able to do this. But I think it's really important to highlight this, what I call fast beauty, because I think I was reading the 10K reports and the 10Qs and trying to understand the business a bit more. And the closest thing that, that came to my mind was actually Zara, the retailer, and how they actually kind of developed the market for fast fashion and the need to innovate constantly, whatever the trends are, and create these new products that appeal to what people's flavors are at that time. And they were able to service that market by just repeating iterations and seeing what the general trend is. And I think that's what they're trying to be here. e.l.f., if I had to give them a little bit of an advantage in terms of what their business model is, which is fast beauty, allowing them to innovate rapidly, because of the fact they're also vegan and pet friendly. You have to understand how this ties in. They are not able to innovate in terms of producing some new molecules or new ingredients for the beauty and cosmetics business because they are pet friendly. They can't go out and test new products. They have to rely on existing products, just create new proprietary blends, and then produce those. So they're relying on the people like, Estee Lauder creating these, or sorry, not even Estee Lauder, maybe L'Oreal, who has a larger, research budget, in order for them to develop and say, hey, listen, you guys can develop it. We're going to duplicate it, dupe it, so to speak, and copy it and make it a much cheaper version that we can mass market to people whenever they want. And that, I think, that could be their advantage. Tie in with the whole digital marketing. If you can tie in digital marketing, fast beauty all together, they might have some advantages there. The only downside is they don't control, let's say, the actual supply chain, the whole industry, in terms of, like, let's say Zara, they've got their own factories, they're producing things, and then they're marketing in their stores. They still have to rely on retailers purchasing their products. So that's the way I would look at their business model as such. So how are they selling their products? Well, generally, they're partnering with these large retailers. Mostly are going to be like the Target, who has 25% concentration of the revenues. And then you have Walmart, which has 17%, and Ulta Beauty around 16%. And there's introductions of, like, say, Dollar General and CVS as well. But altogether, I think that is the largest part of the revenue. So they actually state that 75% of their revenue is coming from these retailers, and then 25% is coming from direct to consumer. So they're through their own website, which allows them to have higher margins. So e.l.f. product revenue distribution. Now, I generally have no idea what these products are, but I'll try to convey this as well as I can. So the face products are like putties. I think those are the things that they mask everything, and the ones they take off at night, and you're like, I don't know who this person is next to me. But those are the kind of products they all have. And then you have the eye products, the mascaras, I think, lip products, and skincare. Generally speaking, out of all of those, they highlight skincare as being the fastest growing area of the market for them. And maybe the whole industry as a whole would grow, it's estimated around 4 to 5%, but they're estimating higher growth rates for the skincare side of the business. Skincare, that's a good one. As for the revenue growth internationally and in the US market, well, they subdivide that into two segments. So the US market is generally 80% of their revenue, and it's 20% internationally. Now, the 20% internationally has been growing rapidly over the last, I think, 2 or 3 years. It was 10% 2 to 3 years ago, and now it's at 20%. So I could see that becoming a sizable chunk of their revenue growth. It's not to say that they're completely penetrated in the US market, and I'll show you some data about this to say, well, they might have some more runway there to grow. But yeah, that's at least appealing to see that they are actually having some good concentration in other countries as well. Specifically, actually, they highlight Mexico as one of their areas that they're seeing good success, Germany and the Netherlands as well, and Italy. So let's drive the point home. Their business revolves around producing clean and ethical products that appeal to the Gen Zs and millennials, who are also more digital, and they'll be able to target through the social media platforms, specifically TikTok, which they're having a lot of success with. Then that will improve their market penetration, which allows them to drive down their cost, per product, and that achieves their economies of scale. And then they can expand geographically into new areas. So overall, I would say that is the long tailwind strategy into geographic expansion for them. So we're not going to look at many company-specific details. We'll look at a lot of those in the financials, but I want to cover a few things here, especially the key KPIs for this business, so you understand what to look for. Their key KPIs they report are net sales growth, EBITDA margins as their two, pillars. And those are important because they actually, I'll come back later to them and cover how they reflect the value of the business. They have been growing astronomically as the last 3-4 years, but recently, their latest quarter, they've had to reduce their guidance by a very minuscule amount. They were talking from 1.31 to 1.3 billion. And that caused, they're stating here there was a -1 to 2% plus revenue expectations, and that caused the market to sell off by about, I think, 25% for the stock. Of course, are the markets, always efficient? No. So there might be an opportunity there we're going to look into. But I want to focus about how this company is using their money as such. Now, they're investing for growth, as they say. And one of the key highlights that you need to pay attention to is how much they're reinvesting into marketing. Because marketing drives more revenue, and that extra revenue they're getting, or let's say profit, they're using to generate more marketing. And it's just a flywheel kind of effect whereby they're just going to keep pouring money into it as long as you're getting, value for their money. And they're spending around 24 to 26% of their revenue on marketing, which is a significant amount for this company, I must say. Like, it's a lot of money. But I think generally in the cosmetics industry, you have to spend the money. because of how fierce the competition is. They're also saying they're spending their distribution capacity, which is good to see. Transition to SAP, is that something that I will see an operational benefit of? I'm not so sure, but they obviously see a benefit to that. And yeah, those are the gross reinvestment strategies as such. So marketing, increased distribution, and a few bit more, increase in personnel, people, and infrastructure as well. And a quick discussion about where I see this business going in terms of how can they keep growing this business. It is truly been the virality of the business, especially on TikTok, that's been driving it, and that's mostly been organic, actually. Despite their, how much they're expanding their budgets and spending on marketing, it's been driven organically by the users themselves making, let's say, beauty videos and things. And whether or not that is something that can, sustain itself is a question. Whether or not these trends end and then, the drop off in the growth rates, halts, that's something that does worry me. The other thing is, are these products nice to haves? Are they must haves? Are they discretionary, or are they, staples? I think they're somewhere in between. People will still pay a decent amount of money because people do care about how they look. Despite if there's a market recession or economic recession, they are still willing to pay that money to cough up. But again, it does allow them, I think, a little bit more room to breathe, because I think because of the fact that they are affordable, they're not the first, the first line of defense would be the L'Oreal's and the other high, more prestige brands, as opposed to the more affordable brands. So in case you weren't aware, there are going to be tariffs coming in through Mr. Donald Trump. And it's going to be a bit of tit for tat between these countries, especially China and the US. So with increased tariffs on China, China might levy some more tariffs onto the US, and who knows where it goes from here. It's an open-ended kind of discussion at this point, and almost every company you can think of has some kind of tie to China. So I wouldn't be worried specifically about e.l.f. I would just say this is an overarching macro kind of effect on all companies. But they did provide some comments on this, saying that, well, we've dealt with tariffs before, and the way we've dealt with it is through supplier concessions. They've asked their suppliers, hey, lower your prices a little bit, and then through selective price hikes. So they've managed to deal with it before with very little damage. They might provide the same playbook, as they say, for the future tariffs coming in. Those tariffs may be a bit higher now, so we'll see how it goes. But I thought it's important for everyone to be aware that this is a real risk if you are investing in this business, and it might deter from their future growth in the fiscal year 2026. So they highlight that their expected year-to-year growth for the fiscal year 25 is 27 to 28%, which is very, very good. I have to say, like any company growing at that rate, it would be spectacular. But because of the fact that they had the historical growth being way higher than this before, I think the market was just getting ahead of itself. The other thing is that the gross margin has been improving year on year, and we're going to get into that. That's sitting now at 71%. I think that's almost best of breed in this area. And we're going to cover this in the industry analysis coming up. So as part of the industry analysis, I think it's important to compare e.l.f. to the competitors. I've selected a group of competitors that may not be exactly like for like to e.l.f. because I wanted a larger selection of companies to compare to, as opposed to 4 or 5, just to have a broader understanding of where they fit generally. So you'll see companies in here like Procter & Gamble, there's Colgate, Palmolive, you have Estee Lauder, you've got Shiseido, you've Coty, which is the CoverGirl brand, and then you have like nails, I think Olaplex, which does nails and hair. Ulta Beauty is in here as well. So, but Ulta Beauty isn't a direct competitor, it's a partner. So, I just wanted to have a general understanding of the entire business and then look at specific companies later if we wanted to compare them to. So what this chart is showing us here is really, this is one of this is how I analyze companies. I put them through my system and I crunch out the data, and it comes out in plots like this. So what we're measuring on the y-axis is the quality of the company. So companies with 100% quality are ranked higher. The x-axis, which is the valuation, and this is just a relative valuation. So what I mean by relative valuation is I'm comparing the company to like-for-like companies. Hey, is this cheaper than that company? Is this company more expensive than that company on a PE basis, on a price to free cash flow basis? And what's nice to see is that with the green trend line is that actually it generally fits what you would expect to see. For higher quality businesses, you are expected to pay more money, and therefore they're more expensive. So the companies like Procter & Gamble, L'Oreal are on the top right corner here. Whereas the cheaper corner, let's say they're under the green line. You don't want to be under the green line, ideally. You have Estee Lauder, you've got Coty, CoverGirl, and then you've got Shiseido. And these are the companies that I would be kind of concerned about. But to be honest with you, this is just a framework for me. I wouldn't use this as my basis for investing. But I thought it's useful to give you guys an idea of how I look at things initially. So this is some further analysis I've done looking at their NOPAT margin. So NOPAT margin is basically their operating income after accounting for the taxes they have to pay. So that's just the quick gist of it. And then on the y-axis, we're looking at their invested capital turns, which is basically how well they are generating revenue for their capital invested. And the higher this number is, the better. Generally speaking, I would urge you to look at, first of all, at some of the work by Michael Mobison, who highlights this, and this is where I got the idea to create this graph from. You want companies either to be a, let's say, low margin business like Costco with a high invested capital return, so they'll be really high up here, or especially in the beauty business, you wouldn't expect more of them to be more differentiated than Costco, right? So they'll have higher margins, but lower invested capital returns. So generally, you'll expect, I look for companies to be somewhere in this arc, like here, in this area. That would be ideal. And you can see that. The nice thing is e.l.f. has some of the highest margins in the business, and their invested capital returns are decent for the amount of margin they're generating. And that's pretty good. This is KVUE, I think it was, that's up here. But I didn't focus on that company specifically. We're looking at e.l.f. today, but I just thought it's nice to paint a picture of how the competitors are doing. Ulta, again, it's not a direct competitor, but everyone's around this arc is doing well, as opposed to the companies in this area. And again, e.l.f. stands out in the fact that it's ROIC minus the WACC, which stands for return on invested capital minus their cost of capital. There's no point generating a high return on invested capital if your cost of capital is higher. You're destroying value as a company as opposed to generating value. And this plot shows that as well, where you want companies to have a high ROIC minus WACC onto the x-axis, as well as, well, this is just a measure of how much profit they're generating as well. So generally, I would say companies are less efficient at generating a high return on capital the larger they are. And you can see that there's this kind of trend as well, that the more, let's say, operating income you're generating, the less efficient you are in generating returns on capital. But e.l.f. is doing really well next to Hims here. So again, the historic metrics all back up the reason why this company was probably very expensive to buy. But is it an opportunity now? All right, so what I wanted to focus on now is a competitor analysis using Google Trends. Now, I know this isn't new, that's something everyone can do, but I wanted to look at some companies of a similar make, focusing in the mass market area of cosmetics, such as CoverGirl, Maybelline, and Revlon, and how that compares to e.l.f. Over time, we see here that for the last 5 years in the United States, which is their biggest market, that growth has been trending upwards. And this is a really good sign that I like to see in companies as well, especially if they are heavy into the branding and marketing side of things, that their exposure in search is increasing. Now, I have to caveat this by saying this is just measuring search results. I don't think it takes into account the social media exposure they have on TikTok, which is huge. But it's still, nevertheless, a great sign that they're getting all this exposure, which hopefully leads to increased direct-to-consumer, selling through the website, and that it is a leader. And this is, regardless of the size, they are the leader. When you take that into account, they're only $4 billion in market cap compared to, L'Oreal, who has a market cap over $100 billion. Granted, Maybelline is not the entire business. It's an umbrella brand underneath the L'Oreal company, but at least a like-for-like comparison shows you, for the size of the company, $4 billion, this is doing very well. So this bodes well for the future of the company, I think. And I'm just teasing some of this data that I'm providing here, which is, I took those 5 businesses, Shiseido, L'Oreal, Coty, and Estee Lauder, which are all publicly traded. Now, unfortunately, I couldn't cover all the skincare and cosmetic industry because there's around 1,900 covered by Nielsen, but I picked 5 of them. And it doesn't tell you the entire growth of the market, but at least in comparison to these competitors, have they been able to take market share? And that's what I wanted to look at. So over the last, let's say, 4 to 5 years, you have to understand what e.l.f. Beauty's market share was. It was 0.51%, which is tiny. It's absolutely tiny. But have they been able to grow it? That's the key question. Well, over the last 5 years, they've gone up to 1.79%. And you're like, that's it? Small market share, right? But no, you need to look at this through the lens of whether or not it's a relative change. So on a relative change, they've grown that for 0.51, 223% to 1.79. So they've had the largest increase in market share as opposed to the rest of these companies. Whereas, let's say, Estee Lauder, Shiseido, and well, those are negative growth. Coty has grown 13%, and L'Oreal has grown 10%. Relatively speaking, it's actually really important to understand this concept, because although L'Oreal is the best of breed business in this area with a improving market share from 51% to 59%, I think they're taking Estee Lauder's market share, to be fair. And if you think about Revlon potentially going out of business, it's also gone into private equity. They've been purchased. So there is room for someone to supplant these legacy names like Estee Lauder and like-for-like competitors like Revlon. So could e.l.f. Beauty do that? That's the key question I would like to answer. And you can see here in other graphs just highlighting this point. Again, relative to the size of the company, how much revenue growth have they been able to generate? The fact is, the younger you are, the more revenue growth you should be able to deliver because you are growing market share. Now, the story doesn't hold true in this chart very well because Shiseido has been losing market share or having a negative growth rate, as well as Estee Lauder. So they're on negative growth rates, whereas the rest of the businesses, you would expect e.l.f. Beauty to have the highest growth rate. I'm not surprised by that. However, the fact that other companies are not growing, especially the Shiseido and the Estee Lauder, they're not growing at all, that was surprising. L'Oreal having 11% higher than Coty is actually interesting for me. It almost wants me, I want to look at L'Oreal a little bit closer if I can in the future. But 46% revenue growth rate for the last 3 years is fantastic. And lastly, just to cover the industry as a whole, just to understand a few key things. Is e.l.f. Beauty vertically integrated, meaning they are in control of their supply, their manufacturing and production, and assembling and packing and then selling the products? No, obviously they are not completely vertically integrated. None of the actual beauty retailers generally are. You could argue that hardly any of them have any retail flagship stores like L'Oreal stores. They all sell through retailers. But generally speaking, the industry is horizontally aligned as opposed to being vertically aligned. Therefore, they do rely on these suppliers. If they could bring all these things in-house, they would raise the, it would no longer be a capital light model. It would be a capital intensive business. And as such, it might not be as attractive to investors. And for, that I've seen that in the semiconductor businesses, foundries are looking, less appealing to certain people. They want hybrid models. Capital light businesses are the way forward. So it might just be best for this business to stay the way it is. Additionally, if you look at the expected market growth for this area, they're saying, well, the market's going to grow at. Additionally, are there any large barriers to entry into the beauty and cosmetics industry? Well, actually, the barriers to entry are relatively low. They are not very regulated. So generally speaking, you can enter this business quite easily. However, the barriers to success are quite high. To succeed in the beauty business, you need to have certain economies of scale, and we're going to get into that shortly when we look at the competitive advantages. So what are the competitive advantages of this business? And well, this is a slide from their investor deck, which I generally looked at and said, nope, I don't think any of these are competitive advantages on their own. So we're going to disregard any of these, to be honest with you, and look through the investment as through the Hamilton-Helmer framework of competitive advantages. You may be aware of this already, but they're divided into scale economies. Does this business have the economies of scale? By basically improving their size, they can reduce their costs. Do they have network economies? Well, I would say network economies, not really, because basically network economies suggest that by having an extra user on the platform, on the network, you've improved the value provided to the customer. And I don't think that does. Basically, if you have somebody using the makeup elsewhere, does that improve? Not really. And therefore, I would say there is a network kind of economy, if you could say, that improves their virality, potentially, but that's about it. Is there any counter positioning? I mean, it's a tough one because I don't think the vegan Pet-friendly aspect is a counter positioning. You could say it is to a certain degree because L'Oreal can't market itself as that because they would cannibalize their own business if they tried to pivot towards that. But they could have a subsection of their business catered to pet-friendly and vegan products and still have their main business, and they don't have to ship the entire model. So I wouldn't say there's a strong play there. Is there strong switching costs for this business? Are you tied down to this business? I wouldn't say so either because people change their views or tastes quite easily, and they're not tied down to a specific brand as such. However, the branding, I think generally, after I said that, I think the branding, you might have a little bit of a competitive advantage in this area. Are there any cornered resources like patents or something not proprietary, but something that they only have access to? I wouldn't say so specifically. So generally speaking, I'm sorry, e.l.f., I don't think you have many of these competitive advantages. However, I would highlight that I think the main advantage they have is, as I said earlier, the fast innovation. So they have what I would say is more power efficiencies in terms of being able to innovate really quickly. They're very lean. Whether or not that changes if they get larger, that's also questionable. But I think they have an advantage of being able to iterate really quickly. And fast fashion could be their niche because the larger companies like L'Oreal may struggle to achieve the same kind of leanness that they have. Also, I do know that I'm missing one of the Hamilton-Helmer points, which is the process power, which suggests that they have more efficiency, operating efficiency as such, but I don't think they actually have that just yet. So let's look at the company management, and there's a few things I want to highlight here that what I thought were good points and less so as well. So this is Mr. Tarang Amin. He is the CEO of the company e.l.f. Beauty, and he's been around since 2014, and he has overseen the IPO stages and then the high growth phase that they've had recently. He has an insider ownership now of 3%. He was not the founder, and therefore he has been increasing his stake through the compensation packages that they've had. I would say that his base salary, 500,000, is decent. That it's not a large amount, and that I like to see CEOs compensated according to their performance. However, how is that performance tied down? How are the long-term incentives for this business? Well, they're tied to revenue growth rates and EBIT margins as well, or EBIT growth, I should say. But the other thing is, it's also that's something I'm not so keen about. I'd rather they were looking at free cash flow as a measure. But I don't want a company that's focused solely on improving the revenue growth rate, because you will actually destroy value for the business if you are really set to just grow the business at all costs. You will drive them into debt. You could do all sorts of things to make sure the business is growing. However, that's not the thing that's going to sustain the business long term. It's free cash flow that will sustain the business. The other thing is, at least a good note, is that they're looking at the share price. So potentially that is tied to total shareholder return. So you can say that over 3 years, they want to see that the share price is higher than it is now. So hopefully that does allow them to align with shareholders as well. And you can see that 6% of his salary is coming, or 6% of his income is coming from his salary, and the rest is based on long-term incentives. So hopefully, fingers crossed, that means for shareholders, it's a good sign. What's surprising, though, is obviously there's a lot of compensation, and that may be due to the fact that the stock has rallied so much. His initial vested performance-based equity has rallied up to now $74 million that he's getting, and that's a sizable amount, I think, for the size of the company at $4 billion. So hopefully, I'd like to see that they are compensated well enough for their efforts, however, not to egregious amounts. I'm not saying this is the egregious amount. I haven't compared it yet to all similar companies, but I would say that it is worrying when you see that much compensation being handed out and potentially so much share dilution for shareholders. So let's take a look at the risks of this business, which are, I wanted to summarize them in a nice, concise format. Generally speaking, the beauty business, you can't dodge this. Everyone is suffering, from competitor rivalry, shelf space risk, which means that basically any retailer will say, well, I only have this allotted space and I have to make room for another competitor. So it might not be directly competing with them, but through the retailers you are. And also, retailers are not obligated for future orders. So it could be that one day they're requesting, I don't know how much X amount of product. Next day, they say, sorry, we don't want it anymore. So that's a big risk because they're not in control of the entire supply chain. The other thing is retailer concentration. So Target makes up about 25% of their revenue. 3 retailers actually make up, I think, over 10%. So that's Target, I think it was Ulta Beauty, and one more. But generally speaking, these 3 retailers hopefully will continue, as they've been long partners with them, continue to do so because they both also will benefit. Well, the other risk is obviously brand damage. Let's say if there's been some bad publicity, let's say someone got allergic reaction, someone died due to makeup, cosmetic industry, or like let's say there is some ingredient in there that causes an allergic reaction. Well, that also could bring us on to the FDA regulation, which they could start to really regulate the cosmetic industry and treat them like drugs potentially, or let's say you have to have approval for certain things before using them. They already have to do this for certain additives in the products, but they generally don't have to do them for all ingredients in them, and that would raise their costs significantly and drive down their margins. So that is a real risk. The other thing obviously is the low switching cost. That's tied to the competitor rivalry as well, but that's from a customer basis. There's low switching cost and low barrier to entry. We touched upon all these before, but just wanted to highlight them again. The China tariffs and shareholder dilution. I see these as all the risks that are involved in the business. Are they solely risks that are associated with or e.l.f? But I wouldn't say so. I would say these are general risks in any business, but it's important to understand what you're getting into if you're investing at this stage. So that brings me to the end of the fundamental deep dive kind of aspect of the business. And hopefully we're going to look into the valuation side of things now. So let's dive into the financials a bit more now. I'm using my Google spreadsheets that I've loaded up with all the information necessary. I need to caveat this by saying first that all the information I'm using is actually been computed and adjusted based on what I think is important. So you might not find this data elsewhere. So please take everything I say with a pinch of salt. This is data that I use, that I adjust from the operating income to the net income to, let's say, the valuation. It affects everything. So do take that into regard whenever I mention any of these numbers. And another thing is I will generally be using TTM data, which is the trailing 12 month on a rolling period, as opposed to the fiscal data that you might see on their website or SEC website when you look and search for a company. That's just because I like to have the more up-to-date data. And we can compare the fiscal data if necessary, but I just wanted to make sure everyone's aware of how I'm getting my data or why it looks different than elsewhere. So the first thing to highlight is that the price has skyrocketed from $8 all the way up to $218, I think around last year sometime. And since then, it has been just almost a steep decline. In the very latest report that they had, I don't know whether or not that was justified. That's what we're trying to find out, obviously. But it was a 25% decline within a few days. So that usually signals either a change in the business fundamentals or something's not right. So let's take a look at it and see what's been happening. Revenue has been growing exponentially, I must say. The revenue growth rate is fantastic. You can see here that for the last trailing 12 months, it's 1.3 billion in revenue. That's 890 million. And they did say that they're going to have a slowdown in the revenue growth rate, or at least how much revenue they're expecting for the next quarter. And I think everyone has just basically jumped the gun and projected declining growth rates, further down the line as well. It's up to us to, judge whether or not that's likely, or can growth further, accelerate? Did they reach an inflection point on the S curve of growth? Have become a mature company now? Well, that's something that we're going to have to look into a little bit deeper. What we can clearly see here is that actually the growth rate per share, or growth rate on its own, has been doing very well for the last 2 years, 3 years, 4 years, and 5 years. In fact, if you even go back all the way to an 8-year CAGR, so that's compounded annual growth rate for this business, it's 21%, which, well, unfortunately here I can't give you that, but under normal circumstances, their growth rates in every single category is 100% nearly, if not 90%. So they're doing fantastically well for themselves in terms of achieving a very high compounded annual growth rate for a business of this. So in regards to their high price or PE ratio valuation, some of it must be justified because of their growth rates, right? And again, their revenue growth rate year on year, if you can see here, that's 79% and then 46% for the latest year. However, if we factor in the new quarter that they're going to be reporting, it's going to be a year-on-year growth rate of 27%. And that's why the stock took such a huge hit. They aren't going to be, their fiscal year revenue is going to be the same as their trailing 12 months revenue. So it's going to be 1.3 roughly. So they're going to be assuming a 27% growth rate from the prior year. And that's why the stock got hit so much, because it has been growing previously at 79%. And then you had 46%, which for the trailing 12 months, and now it's 27%. So people are saying, aha, now this business is in decline. However, I would argue and say that generally the entire space is in decline. Is this a fundamental, change in the business or the industry? Well, the industry has gotten hit. They reported that this was partly due to some of the viral products they were releasing in the prior months that did really well. So of course that pulled forward a lot of the revenue, and now things are normalizing. So when you think about things normalizing, let's remove the operating income and look at this. What's a normal, let's say, let's call it a hill with which revenue should be growing? At some point, revenue is going to slow down, right? But did they reach that inflection point or not? I think realistically, if I get revenue growth on a year-on-year basis of 20%, that's fantastic. So I think that people need to be realigning what a normal price is, and I think that's what's happening in the stock. Everything's getting a reset at this stage. So their operating margins are actually relatively healthy, as you saw on the chart that I showed earlier. That was an adjusted chart, and I'm going to discuss that shortly. But basically, this is the data that you'd normally see, which is to say that their operating margin is 10%. But when I adjust the data for the cost of their marketing, we can see that if that's considered an asset for this business, then their actually operating margin should be roughly around 21%. It does actually, peak and trough from down to 8% to 26% at its highest. So somewhere in between that range is probably their operating margin. And additionally, when we look at free cash flow relative to the free cash flow minus stock-based compensation, we can see the similar trend. At least, there is a very, very clear trend. The spread between the stock-based compensation and just the free cash flow adjusted is the same, which means that they're not diluting us further in certain years than others. It's just a steady dilution throughout. And on a non-adjusted basis, net income, this company is positive. When you adjust it, it's even more positive. As we said, this is adjustment for the cost of their marketing. And how does the adjusted net income compare to, let's say, their adjusted free cash flow minus stock-based compensation? Well, obviously, because of the amount of adjustment, it's a lot more volatile. The free cash flow generally is more volatile, but it's nice to see that at least it's trending upwards, I would say. Some years it has been better. But I would say this company is at an inflection point whereby now they're clearly generating net income. It's just whether or not they can also keep generating that free cash flow. Now, it might be tricky given the fact that they may be entering a period of declining revenues, whereby the inventory stays with them longer. But hopefully they'll be able to manage this with discounts and such, and ensuring that there's a good turnover in that inventory that they have. So their debts have also been increasing lately, obviously because of the Naturium acquisition, which was for $355 million. But really their total assets relative to their total liabilities is still much higher, and they've still got plenty of cash. And we'll look at the interest coverage ratio now. So the interest coverage ratio will measure roughly how they can service the interest on their debt with their free cash flow or operating income. And you can see here that it's been, pretty high up to the 20s and 30s, but then it's been declining down to 8 as of late. And that's a little bit lower than I'd like to see. I prefer to be above 10, but generally speaking, 8, I'm not worried at all for them to be able to service their debt at this stage. So we briefly did look at the ROIC, but just to remind ourselves, the adjusted ROIC for this business is 46%, which is fantastic. It may be even higher if I recall, but in any case, 46% is a great return on invested capital, and I'm very happy to see that in this business if I were to invest in it now. Debt to equity, another ratio people may use to measure the financial health or balance sheet of the business, is actually pretty low as well, below 1. And I think it's almost always been below 1, which is great to see. And additionally, the operating leverage, which looks at how much variable costs they have versus the fixed costs, shows us that it's below 1. Which is good to see, meaning that in an economic downturn, if the revenue gets hit, the operating income shouldn't get hit harder. So that's a good sign. And please feel free to look at the scorecard for this business. This is measuring how well it's performing relative to its peers. There's a lot of green here, which is obviously based on the historical performance. It's by no means measuring the future performance of this business. However, it's still quite good to see that it's that good in terms of its growth rates, its margins, etc. So please take a look at this. Just for comparison, this is the adjusted versus unadjusted performance for the business, or margins. The gross margins are 71%. There's nothing adjusted there. It's still 71%, 62% for the industry average. So they are above the industry that we've selected, or the cohort that we've selected, which is good to see. 10% operating margins versus 21% when adjusted. And then we look at the net income being roughly 0, and then it's around 18% when adjusted. And again, please feel free to pause this. I'm not going to go through each one of these separately, but I wanted to provide some context for how I look at this data. All right, and the valuation data, you can also pause this, but I'll show a different section where I look at specifically the PE ratio, which I think is quite relevant for this business. But generally speaking, we have a 3.3 EV to sales, so enterprise value relative to the sales that they have, and a 2.3, which is the implied value. And I use a few measures to look at just to get an understanding of how cheap this business is relative to its implied numbers. And those implied numbers, I will go into a separate video if I have to discuss these differences. But we'll focus in on the PE ratio in the next part of the video. And briefly, I want to focus in on the PE multiple on an adjusted, unadjusted basis. It doesn't really matter. The trend has been down, and that's usually the case when you see early businesses come up. Initially, they have very high PEs that you can't justify, and eventually they come down. And now the unadjusted PE is sitting somewhere around 42, and the adjusted, well, for me, it's 16. So I'll dive into that a little bit deeper, and whether or not that's actually fair value for this business. So I've tried a new format to hopefully not overwhelm everyone with a lot of numbers, because I know these numbers can get very boring. So I've tried to simplify things into 2 ways that I like to value the business, which is based on the total shareholder return and a DCF. I may occasionally throw in there a reverse DCF if I feel it's useful, but we'll get into that if necessary. So what we can see here is that the unadjusted PE is around 41, and the adjusted PE is sitting around 25.2, which is a little bit higher than what we're seeing in the... So total shareholder return has a few inputs that go into it, but mainly it's going to be EPS growth, contraction or expansion of the PE multiple over the next 10 years or whatever number of years that you've set, and additionally the dividend yield. And then you get a total shareholder return, which for us works out at about 6.6%. Now, just to say how we've come to this number and look at it once more, we've used the 25 normalized and adjusted PE that I get for the company. Now, as you may have seen, or you were paying attention to the previous graph that I showed, the PE adjusted was 16, actually, because that one wasn't normalized. So let's say we adjusted it to use the 17 PE. You can see that 17 and an implied PE of 17 means that we're saying there's going to be a slight expansion as opposed to a contraction in the PE multiple. And how does that change the total shareholder return? Well, it means that we're going up to 9%, which for me is a threshold that I look for, around 9%, because there's certain optionality in businesses that you can't completely calculate. So any upside from there, I'm happy to get if there is any. However, just to continue with more conservative estimates, I'll say it's 6.6% for now, at least on a shareholder return basis, while the unadjusted PE is still 41. And that's why sometimes people may get swayed to not invest in high PE businesses, because they haven't actually calculated the assets that they own, such as the advertising, which is an asset because it eventually will return money to the company, or revenue to the company, and hopefully net income to the company. So these kind of assets like advertising and research generally will bring the PE down if you account for them. The other thing that we're going to look at is the DCF. Now, I haven't actually provided all the numbers for my DCF because I don't want to make this video too long, but generally these are the automated assumptions which we've discussed, 28%, and then operating margin goes from 18% to 12%, and roughly we get a fair value for the stock of 57% with these automated assumptions. Whereas what I think roughly is a middle of the ground scenario for this business is that within the next 10 years, or 5 years at least, they'll be growing revenue at 20%. And then their margins stay steady, let's say, for the next 10 years at 19%, which is kind of just a very conservative estimate. They could very likely improve a lot more than that. But what we get is a fair value of $72 for the business. And the price of the stock right now is around $73. So You could argue that for these kind of assumptions, you would be getting a stock at fair value. I have no problem usually paying for fair value. It's just whether or not I feel this business is a compelling enough business to invest in for long, sustainable advantages. The rate of return you get for this business, actually, if you've been paying attention to these numbers, the funny thing is that you end up with a higher price of the stock in 10 years than you would with the one that is a fair value. This one is a fair value of $57, so you'd still have to wait. But because of the huge growth rates that it has, you actually will eventually reach that fair value number somewhere around year 3 or 4 or 5. And then eventually you'll reach a higher price because of the higher revenue growth. So you can see even sometimes this is why growth investors actually will buy things over the value, but eventually realize a higher profit than somebody who's just looking for cheap businesses, because you eventually will realize that if you hold it long enough. So those are the two ways I like to measure businesses. The last thing I want to do is just touch on a Monte Carlo simulation, which is a little bit overboard maybe, but I wanted to highlight this just to show potentially what are some outcomes that you can get if you find it very difficult to analyze a business which has a big standard deviation potential outcomes. They could be growing revenue at 5% or maybe 40%. So this is the Monte Carlo simulation that I ran for e.l.f. Beauty. What I tried to adjust were two variables mainly, which are the ones that cause the biggest difference in the actual fair value of the business, which are the revenue growth and the operating margin. Generally speaking, the revenue growth, let's say, curve of potential outcomes follows what we call a log normal distribution, meaning that most things are usually within the kind of like set boundaries of the mean of, let's say, in this case, 20%. But there are some huge outliers to the tail end scenarios. And that could be like, let's say, 80%, 90%. If you're crazy enough, you could say, 100% or more revenue growth. But we tried to estimate, let's say, 10,000 simulations of potential different revenue growth rates and operating margins to arrive at 10,000 DCF assumptions. So what you can see from the percentile data is suggesting that, let's say, in the worst case outcome, based on what inputs I gave it to work with, the Monte Carlo simulation, it told me that the stock is worth $44. And that's the worst case scenario, that it's worth $44. Best case scenario, 99th percentile, it's worth almost $2,000. But what I'm looking for is like the middle ground scenario. So 50th percentile is $81. So I think we're fairly close to what the prices were given in my assumptions already done in the DCF, but this helps paint a better picture of potentially what are the possible scenarios that could be, instead of doing a bear case and bull case and middle ground case. So I like to look at things like this. And then it also helps me to estimate if I potentially want to sell a stock, whether or not we want to get out of it at, let's say, the 90th percentile or 80th percentile. So that's it for today. We've covered the fundamentals of the business and we've covered the valuation. So please do let me know which one of these is more interesting to you. If you prefer either just a separate deep dive and a separate valuation video, I'm very keen on learning and hearing back from you, and let me know which one you prefer. And as far as the stock goes, e.l.f. Beauty is interesting, I must say. The valuation is pretty compelling given the story of potential long runway for growth and potentially rising in market share and in market penetration worldwide. However, I'm looking generally for sustainable businesses that let me sleep well at night. And whether or not I can sleep well at night holding e.l.f. Beauty is another matter. Does it have sustainable competitive advantages? That's kind of tricky. It's not as robust as I would like it to be, for sure. There's no moat that suggests that if the company was to disappear tomorrow, the world would shut down. Customers are obsessed with the business, so that's a good sign. But it was one that I would say the price is very interesting, and I would nibble at this stage maybe 1% of my portfolio. But I would have to carefully watch this and see how the business progresses from here. We can say that the downside is capped, and it's not that far away. Let's say if we estimate it being like $44, we may lose another, let's say, 30%. But again, this business has a lot of potential to the upside, and that's sometimes what you need to look for in terms of asymmetric upside potential scenarios. So I hope you guys do your own due diligence. Please don't take any of this as gospel. And hopefully I'll have more material out there sooner rather than later. And I'll catch you in the next video. Thanks.